Welcome to this presentation on economic and market scenario. The global financial markets have been passing through a period of high volatility during June and so far in July this year. Financial markets, credit markets, bond markets, and to an extent, equity markets have been experiencing very high volatility. Much of this volatility is due to the economic news coming from the United States of America. Therefore, let us start by looking at the U.S. economy and the news emerging from the U.S. There are very clear signs that the U.S. economy is coming back to the era of good growth. The U.S. is not experiencing a V-shaped economic recovery, but there are clear indications of sustained economic recovery. All economic indicators, macro indicators are looking better. GDP growth rate is improving. Macroeconomic data like unemployment figures, employment generation, business confidence, all these are looking much better. In June, the US added 1,95,000 jobs. So there are clear indications of a big improvement in the US economy. This has emboldened the US Federal Reserve System to very clearly declare that they will consider tapering the quantitative easing program, which they started in the context of the global financial meltdown of 2008. Presently, the QE3 is in vogue, and the Federal Reserve System has been injecting $85 billion into the global financial system since September 2012, when the QE3 was started. So the news of QE3 tapering has impacted global financial markets. So what is this QE tapering? Under the quantitative easing program, as I said, the US federal system has been buying bonds from the markets, thereby injecting liquidity into the markets. This has been keeping the interest rates very low, and this acted as a monetary stimulus for the revival of the economy. The US has very clearly said, the Federal Reserve System has very clearly said that the QE3 tapering, that is slowing down of the bond purchases and the eventual ending of the bond purchases, will be conditional upon, one, the unemployment rate coming down to 6.5%, and two, the inflation outlook going beyond 2.5%. The US economy is still a long way away from these goals, but let us accept this. There are very clear signals that the US economy is inching towards lower and lower unemployment and slowly rising inflation. Therefore, it is quite possible that by the end of this year, perhaps even as early as September 2013, the Fed will start reducing their bond buying program, that is tapering the QE3, and this might end, the QE3 might end by mid-2014, and it is quite possible that by 2015 early, the US will start increasing the interest rates. Now this US economic recovery is very good news. It is good news for the US economy. It is good news for the global economy, because the US is even now the largest economy in the world, by far the largest economy in the world. And this is good news for the emerging markets also, because the emerging markets will gain from US economic recovery. This is good news for emerging market exporters. But unfortunately, this good news for the economy is turning out to be bad news for the markets. This is the perverse economic logic that is impacting the market now. Good economic news is becoming bad news for the market. The reason is, as I explained, the markets have been, particularly in the emerging markets, remaining buoyant because of this liquidity infusion from the quantitative easing program. And the news that this quantitative easing program is going to end, tapering and slowly end, means that the flow of liquidity from abroad will decline, the flow of liquidity into the stock markets will decline, and this will have negative implications for the stock market. And this is the reason why the stock markets have been negatively impacted, particularly in emerging markets. The stock markets are considerably down in dollar terms this year, whereas in the US, the stock market is up by 13% this year. The economic news for the rest of the world is mixed. According to the data coming from the OECD, Europe is likely to continue in recession in 2013, but there are indications of improvement. 2014 might see a stabler Europe and economic conditions improving in Europe. Japan is clearly on the path to economic recovery, but in emerging markets, which has been doing very well even during the global slowdown, there are signs of economic slowdown. China has slowed down by 2.5%. India has slowed down by 2.5% from the peak. So this big slowdown in the US and in China and India has led to slowdown in the emerging markets. Therefore, the growth differential between the developed markets and emerging markets is narrowing down. This is the global economic scenario. Coming specifically to the Indian economic scenario, India's macroeconomic situation is not all that good. Macroeconomic scenario is not very satisfactory. We will be lucky to post a 6% GDP growth this year. Fiscal deficit is coming down, but the current account deficit at around 4.8% of the GDP is unsustainable and on the high side. Our foreign exchange reserves are now around $285 billion, but our foreign exchange debt has shot up by 12% during the last 1 year to $390 billion. And the worst part of this balance of payments picture is that short-term debt, that is debt with a maturity period of less than a year, constitute 43% of our short-term debt. Also, short-term debt accounts for 60% of India's foreign exchange reserves. These are not sustainable. These are certainly bad news. We have to accept this reality. That's why I said our macroeconomic scenario is not very satisfactory. But the markets have to an extent discounted this bad news. The positive side is there are lots of good news which the market has not discounted. Market is refusing to discount in this scenario of some extent of risk off in the emerging markets. And this positive news are, number one, the U.S. economy is coming back to health. This augurs well for India's exports. This augurs well for India's GDP growth also in this year, because America is even now India's largest export market, particularly for our industries like IT-enabled services and pharmaceuticals. US is the largest market. The second economic news, positive economic news, is the bountiful monsoon that we have received so far this year. Till July 8th, that is, monsoon at the national level is in excess of 25%. That is, monsoons are 25% above long-term average. This augurs well for agricultural production this year. This will give a big boost to India's agricultural production and also India's GDP. Even now, 52% of our labor force is engaged in the agricultural sector. Therefore, good agriculture will boost the incomes of 52% of Indians. This in turn will boost the fortunes of many agriculture-related industries like fertilizers, pesticides and insecticides, tractors, then fast-moving consumer goods, two-wheelers, and a whole host of consumer goods. This is good news for the corporate sector, good news for the markets, and the stock market is yet to discount this very favorable development. Very soon, when the markets become stable and the volatility ends, the markets will start discounting these positive developments. Also, the fiscal deficit is coming down. That is very positive. We are better than our budget estimates of fiscal deficit at this point in time. And it is also possible that the current account deficit, which is the major macroeconomic problem which the economy is facing now, that also is slightly coming under control. The latest data tells us that gold imports, which touched 165 tons in May, is down to mere 35 tons in June, thanks to the softening gold prices. So if this softening of gold imports continue, then it is quite possible that our current account deficit will be much lower than what the present estimates indicate it to be. This will have a positive impact on rupee dollar exchange rate also. So that is the positive side which the markets have not yet discounted. So the perverse logic in the markets is now being driven by news of quantitative easing, fears of liquidity outflows from emerging markets like India, and of course countries with a high current account deficit like India, South Africa, Turkey, Chile, etc. are being impacted much more than other emerging markets. That is quite natural. Coming to the investment strategy, investors should accept the fact that for the coming days and for the coming weeks, markets will continue to be very, very volatile. There will be excessive volatility in the markets. Investors should keep a sizable part of their investable funds in cash. That means they can invest this money in liquid funds. Liquid funds are giving a return of around 8% now. So a lot of cash can be parked in liquid funds, and every decline in the markets, major declines in the markets, should be used as opportunity to buy into good quality stocks. Because now the valuations are attractive. There is still a downside risk to the markets, but valuations are attractive, and there are very good stocks with very good potential in private sector banking, in IT, in pharmaceuticals, and even in beaten down stocks like automobiles, engineering, etc., which are attractive buys, which will become attractive buys during market dips. So market dips, particularly big corrections in the market, and big corrections are happening very frequently these days, should be utilized by investors to buy into good quality stocks. Stocks of good quality companies with quality management, good track record of corporate governance, with minimum leveraging, with zero debt or very low debt on their balance sheet, and very limited exposure to foreign debt. Such stocks, particularly in performing industries, should be accumulated on declines. Mid-caps are now offering very good opportunities, but individual stocks can be risky here. Investors should invest in mid-caps through ETFs or through mutual funds which are focused on good mutual funds with a good track record, which are focused on mid caps. That will be a better strategy while investing in mid cap stocks. Investors should always keep in mind the fact that the India growth story is very much intact. We should never forget this. It is a fact that the India growth story has been temporarily negatively impacted, but the factors driving the India growth story in the long run, factors like our high savings rate, high investment rate, a good corporate sector, an explosion of entrepreneurial talent, diversified stock market, all this will stand the Indian economy in good state. And when things become very normal, particularly in 2014 after the next parliament elections, when a sustained bull market is possible, things will start looking very well. You can never buy stocks at the lowest valuations. You can never buy at the highest valuations. So calibrated buying at every dips would be a good investment strategy. Investors investing in good quality stocks, investing for the long term, investing continuously will be rewarded in the long run. Thank you.
Now you can play your music as loud as you want.
There's always a simpler way to do things. Trade online at Geojit BNP Paribas. It's fast, easy and secure.